Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories within financial filings. Get ready, because today we're diving into the latest report from Columbia Funds series. Trust me, there are some interesting numbers in here that paint a pretty clear picture of how these investment portfolios are doing and what it means for the people who invest in them now before we get too deep into the nitty gritty. If you love getting these kinds of straightforward breakdowns of complex financial documents, make sure you hit that subscribe button and ring the notification bell so you never miss an episode. We also have a fantastic community growing on Discord, linked in the description below, where we talk all things finance and investing. So come join the conversation. Alright, so what are we looking at here? This is a certified shareholder report, essentially a check, up for mutual funds that are part of the Columbia Funds Series Trust. Think of it as their financial health report card. It covers a period ending the 31st of July 2025, giving us a snapshot of their performance and investments. The important stuff here is really about where the money is invested and how much it's costing the investors. We see these reports come out regularly and they give us a real window into the fund's operations. It is not always the flashiest read, but it is vital for understanding what you're actually putting your money into. Let's break down what we found, starting with a look at the costs for investors. For example, for Class A shares of the Columbia Capital Allocation Moderate Conservative Portfolio, a hypothetical $10,000 investment would have cost about $22 over this reporting period. That might sound small, but it is important to remember this is annualized. That means if you kept that $10,000 invested for a whole year, those costs would add up for Class C shares of the same portfolio. That hypothetical $10,000 investment cost around $60 annually. That difference might seem minor at first glance, but over long periods and with larger sums, it can really impact your overall returns. The institutional class shares, on the other hand, were much cheaper, costing only about $10 annually for that same $10,000 investment. This highlights how different share classes have different cost structures, which is a key thing to be aware of when choosing where to invest. Now let's talk about the size of these portfolios. For the Columbia Capital Allocation Moderate Conservative Portfolio, the total net assets were a massive $333,821,483. Not bad at all. This gives you a sense of the scale we're dealing with. The report also shows us exactly what these funds are invested in. A big chunk of the Columbia Capital Allocation Moderate Conservative Portfolio, for instance, is held in other Columbia funds. We're talking about percentages like almost 15% in the Columbia Bond Fund Institutional 3 class, over 12% in the Columbia Quality Income Fund Institutional 3 class, and nearly 12% in the Columbia US Treasury Index Fund Institutional 3 class. This tells us a lot about the fund's strategy. It's not directly buying individual stocks or bonds, but rather investing in other specialized funds, mostly from within its own Columbia family. This kind of structure is common in mutual funds, but it's always good to know where the money is actually going, especially when a large portion is held in affiliated funds. It's like a fund investing in its own siblings, which can offer some efficiencies, but also raises questions about independence. Moving on, let's look at the Columbia Capital Allocation Moderate Aggressive Portfolio. This one is much larger, with net assets reaching over $1.7 billion. Here, the top holdings are a bit different. The largest single holding is the Columbia Large Cap Growth Fund Institutional 3 class, making up about 12.5% of the portfolio. Then we have the Columbia Contrarian Core Fund Institutional 3 class at 12.3% and the Columbia Overseas Core Fund Institutional 3 class at 12%. Again, we see a pattern of investing heavily in other Columbia funds, but this time with a stronger emphasis on large, cap growth, and overseas equity. Now, the real meat of any of these filings is in the financial tables. Let S dive into the portfolio of investments for the Columbia Capital Allocation Conservative Portfolio as of the 31st of July 2025. You can see here it shows where the money is parked. For instance, they have over $7 million invested in the Columbia Overseas Core Fund Institutional 3 class. They also hold over $6.9 million in the Columbia Contrarian Core Fund Institutional 3 class, and over $5.8 million in the Columbia Select Large Cap Equity Fund Institutional 3 class. All these entries add up to show how the fund is allocated. Looking deeper, we see significant investments in bond funds too. They have over $29 million in the Columbia Bond Fund Institutional 3 class alone. Combined, the fixed income portion of this conservative portfolio is a huge $102.7 million. Remember, these are just the investments in securities, and there are other assets and liabilities that make up the total picture. What's also very interesting here is their use of derivatives. These are financial contracts whose value is derived from underlying assets. For example, they had forward foreign currency exchange contracts with a total unrealized appreciation of $60,465 and an unrealized depreciation of $49,646. They're essentially hedging against currency fluctuations. They also have futures contracts, some long and some short, used for managing exposure to market movements and interest rates. Think of these as bets on the future direction of indexes like the S&P 500 or government bonds. They also engaged in total return swap contracts. For instance, receiving SOFR plus a certain percentage and paying the total return on the Russell 1000 value index. When we look at how these investments are valued, the report breaks it down into 3 levels. Level 1 are investments valued based on quoted prices in active markets. For this conservative portfolio, the entire $30.3 million in equity funds, $102.7 million in fixed income funds, and $16 million in money market funds are all level 1. This means they are generally easily valued based on market prices. The derivatives are mostly level 2, meaning they rely on other observable inputs like interest rates and credit risks. This suggests a good degree of transparency in how their investments are valued, which is always a positive sign for investors. The notes section also reveals a critical piece of information: the significant holdings in affiliated issuers. For the conservative portfolio, we see a substantial amount, over $152 million at the beginning of the period, invested in funds managed by Columbia itself. While they made substantial purchases and sales, ending the period with over $149 million in these affiliated funds, it confirms this fund is heavily invested within its own ecosystem. It is crucial to understand that while this can create cost efficiencies, it also means a large part of the fund S performance is tied to how well Columbia S other funds are doing. Let's switch gears to the Columbia Capital Allocation Moderate Conservative Portfolio. This fund is significantly larger, with net assets of over $333 million. Here, we see a similar pattern of investing in affiliated funds, but with a different emphasis. The fixed income portion is substantial, with over $49 million in the Columbia Bond Fund Institutional 3 class. The total fixed income investments come out to over $196 million, representing about 59% of the fund S assets. Equity funds make up about 35.5% of the portfolio. This fund is clearly leaning towards a more balanced approach with a strong bond allocation. The statement of assets and liabilities shows that for this moderate conservative portfolio, the net assets applicable to outstanding capital stock are $333,821,483. The breakdown by class is also telling. Class A shares have net assets of over $302 million, Class C shares over $17 million, and institutional class shares over $12 million. This indicates that the vast majority of investors are in Class A shares, which often come with higher sales charges compared to institutional shares. Looking at the statement of operations for the 6 months ended the 31st of July 2025, we see that this portfolio generated over $4 million in net investment income. However, a significant part of the fund S gains, over $11 million, came from realized and unrealized gains, particularly from those investments in affiliated issuers. This tells us that while the fund is generating income, its overall performance is heavily influenced by market movements in its underlying investments. In the financial highlights, we see the performance metrics for each share class. For Class A shares of the moderate conservative portfolio, the net asset value at the end of the period was $10.35. The total return for the 6 months ended the 31st of July 2025 was 4.81%. The gross expense ratio was 0.54%, which is pretty reasonable, especially for a mutual fund. But what's really interesting is the net expense ratio, which is also 0.54%. This implies that while there might be some expense waivers happening, the actual cost to the investor is what is reported here. The portfolio turnover rate was only 3%, meaning they aren't trading assets in and out very frequently, which can be a sign of a more long-term investment strategy. Now, let's briefly touch on some of the broader financial health indicators. While most of this report is about the specifics of the fund's holdings and costs, we can glean some general insights. For instance, the receivable for investments sold and receivable for capital shares sold, these represent money owed to the fund. If these numbers are consistently high and growing, it might suggest strong sales activity. Conversely, payable for investments purchased and payable for capital shares redeemed show money the fund owes. These are standard parts of financial reporting, and the key is to watch their trends. Are they growing disproportionately to the fund's overall size? And what does that imply about cash flow management? The notes on derivative instruments reveal that for the moderate conservative portfolio, the realized loss on derivatives for the 6 months ended the 31st of July 2025 was over $1.2 million. This is a significant number and shows that while derivatives can be used for hedging, they also carry the risk of substantial losses. The change in unrealized appreciation on derivatives was positive, over $800,000, meaning some of these derivative positions are currently gaining value on paper. This constant flux highlights the dynamic and sometimes volatile nature of these financial instruments. Finally, let's look at the approval of management agreements. This section is crucial because it tells us how the fund's leadership assesses the performance of the investment manager, Columbia Management Investment Advisors, LLC. They carefully reviewed things like investment performance, fees, and the quality of services provided. For the moderate conservative portfolio, the board noted underperformance in certain periods, but also acknowledged steps taken to improve performance. This is a very transparent way of admitting that not everything is perfect, but they are actively working on it. They also compared fees to similar funds and determined that Columbia's fees were in line with market standards. The board ultimately approved the renewal of management agreements based on a holistic view, not just one single factor. They considered investment performance, the range of services, and competitive fees. For example, they noted the profitability of the investment manager and its affiliates, but concluded that the fees allowed for competitive compensation and reinvestment in the business, which is a reasonable justification for keeping fees as they are or slightly adjusted. Looking at these filings tells a story. We see large funds, significant investments in affiliated funds, and a complex web of derivative strategies. The costs for investors vary significantly by share class, and managing these costs while aiming for good performance is the constant balancing act. The analysis of management agreements reassures investors that the board is actively scrutinizing the firm managing their money, looking at performance, fees, and overall service quality. While there are always risks, particularly with derivatives and market volatility, the disclosures provided here are generally robust. The use of affiliated funds is a key characteristic to keep in mind, as is the ongoing expense management. For now, the moderate conservative and conservative portfolios seem to be holding steady, while the aggressive ones are taking on more market risk in pursuit of potentially higher returns. So that is our deep dive into the latest Columbia Funds filing. What are your thoughts on these numbers and what they mean for the future of these investment portfolios? Let us know in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more insights into the world of corporate finance. And don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.